On September 3, 1929, five stocks accounted for more than one-third of the entire U.S. stock market's value. Radio Corporation of America had surged 5,000% in 7 years. Investors called it the new era. 73 days later, the market began a collapse that wouldn't bottom for 1,041 days. The concentrated stocks fell hardest. RCA dropped 97% from its peak. Today, as of November 2025, 7 tech stocks represent 32% of the S&P 500's value, with Nvidia alone comprising 7%. History doesn't repeat, but Wall Street's memory is reliably short. Picture this scene from September 1929. The offices of Goldman Sachs Trading Corporation at 30 Pine Street, Manhattan. Investment trust managers are stacking leverage upon leverage. The Goldman Sachs Trading Corp holds shares in Shenandoah Corporation, which holds shares in Blue Ridge Corporation, which holds shares in RCA. 3 layers of borrowed money, all betting on the same revolutionary technology. Radio. When RCA's stock hit $500, the pyramid looked brilliant. By 1932, with RCA at $11, the structure had vaporized $475 million in investor wealth. That's worth $8.7 billion in today's money. The Goldman Sachs Trading Corp itself launched at $104 per share in December 1928, traded at $1.75 by 1932. Here's what should grab our attention about this pattern. It wasn't just retail investors getting caught in the frenzy. The most sophisticated financial institutions of that era concentrated their positions in the exact same stocks, because the career risk of missing out was greater than the financial risk of joining the crowd. Let me walk you through how this looked in real numbers. In March 1928, General Electric was trading at $400 per share. That's $7,200 when you adjust for inflation. The company represented 11% of total market capitalization. Think about that for a moment. One company, 1/10 of the entire stock market. General Electric had genuinely revolutionized American life with electric appliances. The technology was real. The transformation was happening. Yet the stock was priced for absolute perfection. By July 1932, those $400 shares traded at $34, a 91.5% decline. The Federal Reserve Bank of New York, under Benjamin Strong, had kept discount rates artificially low at 3.5% from August 1927 through July 1928, fueling the speculation that made those valuations possible. Then there was RCA itself, the Nvidia of its era. By September 1929, the stock hit $505 per share, $9,100 in inflation-adjusted terms. The company had grown revenue 20 times over in 7 years as radio swept across America. Investment trusts held massively concentrated positions. Blue Ridge Corporation had 42% of its assets in RCA, not 4%, 42%. By 1932, those $500 shares traded at $11. The concentration wasn't hidden in retail portfolios. Institutional investors at Massachusetts Investors Trust, America's first mutual fund launched in 1924, had loaded up on the same stocks. They created systemic risk by design. You might think the safe play would have been AT&T, the defensive stock. The bond-like stability everyone trusted. AT&T traded at $304 per share in October 1929, representing 12% of market cap. Institutions treated it as their hedge position, while taking excessive exposure to the concentrated leaders. Even this defensive holding fell 67% by 1932 to $100 per share. Here's the lesson that matters for us today. In concentrated market structures, nothing is defensive when the unwind begins. What does all this reveal about how our markets actually work? The 1920s established a pattern that recurs every generation. Cheap credit flows into breakthrough technology. The Federal Reserve's discount rate of 3.5% made borrowing easy. Institutional investors concentrate positions because this time is different. The technology really is revolutionary. Leverage amplifies exposure across the system, and the narrow leadership contains massive systemic risk that nobody wants to acknowledge until it's too late. The Goldman Sachs Trading Corp wasn't some rogue operation. It was the system working exactly as designed. By 1929, Investment trusts, the ETFs of their era, held $8 billion in assets. That's $145 billion in today's terms. 743 trusts. Launched in 1929 alone, they were all buying the same 5 stocks. When those stocks fell, there was no diversification to cushion the impact, no hedging strategy to limit losses, just synchronized selling across the entire financial system. According to Federal Reserve historical data, the concentration in those 5 stocks created a mechanical vulnerability. When RCA fell, the investment trusts holding RCA had to sell other holdings to meet redemptions. That selling pressure hit General Electric, which triggered more redemptions, which forced more selling of AT&T and General Motors. The concentration amplified every downward move because the same institutions held the same stocks with the same leverage at the same time. Think about your own investment portfolio. Right now, if you own an S&P 500 index fund, you have 32% exposure to 7 companies, whether you know it or not. The technology these companies are building might genuinely change the world, just like radio and electricity changed the world in the 1920s. But here's the uncomfortable question we need to ask ourselves. Are we in the transformation phase where these valuations make sense? Or are we in the concentration phase where systemic fragility is building beneath seemingly unstoppable momentum? The 1920s investors were right about the technology. They were catastrophically wrong about the timing and the stocks. So, how does this concentration actually build in the first place? What's the mechanical process that creates these dangerous patterns generation after generation? The answer reveals something uncomfortable about how our financial system is structured, and why the people managing our retirement accounts might be trapped in a cycle they can't escape even if they wanted to. The concentration crash cycle operates on a 3-stage mechanism that has repeated with remarkable consistency since the 1920s. Each stage feeds into the next, building momentum that feels unstoppable until suddenly it reverses with devastating speed. Stage 1 is credit expansion, creating the initial rise. This happened from 1927 to 1928, again from 1996 to 1999, and most recently from 2020 to 2024. The Federal Reserve lowers interest rates, making borrowing cheap and pushing capital into stocks. In 1927, the Fed cut its discount rate from 4% to 3.5% and bought $400 million in government securities. This forced money out of safe bonds and into equities. In 2020, the Fed cut rates to 0 to 0.25% and bought $4.6 trillion in assets. Both periods saw money flow disproportionately into growth stocks with exciting narratives. Radio and electricity in the 1920s, the internet in the 1990s, artificial intelligence in the 2020s. But here's where it gets interesting. The cheap credit doesn't spread evenly across all stocks. It concentrates in whatever narrative captures institutional imagination because of Stage 2, which is where career risk creates the herding behavior. Stage 2 is institutional herding, creating concentration. This phase ran from 1928 to 1929, from 1999 to 2000, and we're watching it unfold right now from 2023 to 2025. Fund managers face a brutal reality that has nothing to do with picking good investments and everything to do with keeping their jobs. If Nvidia rises 200% and you don't own it, you lose clients. Your fund underperforms. Your bonus disappears. Your career suffers. This creates synchronized buying across the entire institutional landscape. Let me show you how this looked in 1929. Investment trusts held overlapping positions in the same 5 stocks because every manager was watching what every other manager was doing. In 2000, according to Morningstar data, mutual funds had 42% of their assets in technology stocks. By November 2025, the top 7 tech stocks comprise 32% of S&P 500 market cap. That's the highest concentration we've seen since the dot-com peak, and it's not because 7 companies suddenly became 1/3 of the American economy. It's because institutional money herded into the same names. Think about what this means for the average person saving for retirement. You probably think you're diversified because you own an index fund. But that index fund is mechanically required to match the concentrated positions that the market itself has created. There's no escape hatch built into the system. Stage 3 is where valuation extremes meet credit tightening. This is the unwind phase. It happened in 1929, in 2000, and it's the phase that history suggests comes next. Eventually, the Federal Reserve tightens credit, or earnings disappoint, or some external shock hits the system. The concentrated stocks fall first and hardest because they carry the highest valuations and the highest institutional ownership. More importantly, selling begets more selling. In 1929, the Fed raised rates to 6% in August. In 2000, the Fed raised rates from 5.5% to 6.5% between May 1999 and May 2000. The narrow leadership unraveled rapidly in both cases because everyone was holding the same stocks and everyone tried to exit through the same door simultaneously. Let me give you specific examples with real numbers so you can see exactly how this mechanism has played out. On May 31st, 2000, Cisco Systems had a market cap of $555 billion, the largest company in the world, trading at 200 times earnings. Institutional ownership stood at 62% of all shares. Fidelity's Magellan Fund, the most famous mutual fund in America, held $8.7 billion in Cisco. That was 4.2% of the fund's entire assets in a single stock. Janus 20 Fund had 18% of its assets in Cisco. By October 2002, Cisco's market cap had collapsed to $97 billion, down 82.5%. Here's what matters about that example. The concentration wasn't hidden, it was celebrated. Morningstar gave Janus 20 a 5-star rating in 1999, despite the catastrophic concentration risk. The fund manager was praised for bold conviction. Then the stock fell, and suddenly everyone pretended they'd seen the risk all along. Pop quiz. What percentage of the entire U.S. stock market did 5 tech stocks represent in March 2000? Microsoft, Intel, Oracle, Dell, and Sun Microsystems combined for $2.9 trillion in market cap. That was 17% of the entire stock market concentrated in 5 companies. The Vanguard 500 index fund held all 5 at market weight, meaning anyone who thought they were playing it safe with an index fund had 17% exposure to 5 companies. By September 2002, that combined market cap had fallen to $830 billion, down 71%. Index investing, promoted as diversification, had become a concentration vehicle delivering synchronized losses. But it gets worse when you look at the laws that enabled this pattern to become embedded in our financial system. The 1940 Investment Company Act, still in effect today, allows mutual funds to hold up to 25% of assets in a single security under Section 5(b)(1). Think about that legal framework for a moment. The law gives explicit permission for catastrophic concentration. The assumption was that fund managers would self-regulate and use that flexibility sparingly. Instead, they optimized for career survival, which meant matching or exceeding the concentration of their competitors. Then came the 1974 ERISA Act, the Employee Retirement Income Security Act, that governs pension funds. This law required pension funds to invest prudently, which sounds reasonable until you understand how courts interpreted that requirement. Prudent became defined as matching benchmark indices. This pushed $2.4 trillion in pension money by 1999 into the same stocks at the same time. According to Federal Reserve flow of funds data, this created a situation where herding became legally protected behavior. You couldn't get sued for losing money if everyone else lost the same money in the same stocks. Let me show you another historical example that demonstrates how these laws play out in practice. In January 1974, institutions concentrated in 50 stocks they called the Nifty 50. These were supposed to be one-decision stocks you could buy and hold forever. Polaroid traded at 95 times earnings, Xerox at 48 times, McDonald's at 83 times. Morgan Guaranty Trust, the most prestigious bank of its era, held concentrated positions in these names. Federal Reserve Chairman Arthur Burns had raised interest rates from 3.5% in 1971 to 13% by 1974. The Nifty 50 fell an average of 67% from 1972 to 1974. Polaroid collapsed 91%. Xerox fell 71%. The S&P 500 fell 48%. But concentrated institutional portfolios fell 60 to 70% because they were all holding the same stocks. Here's an even more extreme example from December 1968. National Student Marketing Corporation was the darling of institutional go-go funds. The stock hit $144 per share. Fred Carr's Enterprise Fund held 7% of total assets in this single stock. Fred Alger's fund held 5.2% in national student marketing. Within 2 years, the stock traded at $3.50, down 97%. The company's accounting turned out to be fraudulent, but here's the key insight. Institutions didn't care during the momentum phase. They cared about quarterly performance versus their peers. The legal framework protected them as long as everyone else was making the same mistake. The 1975 SEC abolishment of fixed commissions made active management more expensive, which accelerated the shift toward index funds. By 2025, passive funds hold $14 trillion in assets. This creates automatic buying of whatever stocks rise, regardless of valuation. The S&P 500 committee adds winners and removes losers, which creates mechanical buying pressure on concentrated names. When a stock gets added to the index, passive funds must buy it. When it rises and becomes a larger percentage of the index, passive funds must buy more. The system is designed to amplify concentration. According to the Bank for International Settlements, this passive investing structure creates a feedback loop where price momentum becomes self-reinforcing until it suddenly reverses. Rising stocks attract more money, which pushes prices higher, which attracts more money. The mechanism works beautifully on the way up. It works with equal efficiency on the way down. Except in reverse, there's panic and forced selling instead of optimism and voluntary buying. What this reveals is that the concentration we're seeing today isn't an accident or a series of independent decisions by smart investors who all happen to believe in the same 7 companies. It's the mechanical output of a system designed by laws written decades ago, operated by institutions optimizing for career survival rather than client outcomes, and amplified by passive investing structures that must buy whatever rises. The individuals making these decisions are rational. The system they're operating within produces irrational outcomes. And for those of us with our retirement savings caught in this machine, understanding the mechanism doesn't provide an escape route. It just helps us see what's coming before it arrives. So here's where we connect the historical pattern to what's happening right now in our portfolios. From January 2023 to November 2025, Nvidia, Microsoft, and AMD have created $4.7 trillion in added market cap. To put that in perspective, that's more than the entire GDP of Germany. The Federal Reserve held interest rates at 0 to 0.25% from March 2020 to March 2022, igniting exactly the kind of speculation we saw in the 1920s and 1990s. By November 2025, 7 stocks represent 32% of the S&P 500. That exceeds the 28% concentration we saw at the dot-com peak in 2000. Let me give you the numbers that should make every investor pause. Nvidia trades at 48 times sales as of November 2025, not 48 times earnings, 48 times revenue. At the March 2000 peak, Cisco traded at 35 times sales and was considered absurdly expensive by anyone paying attention. We're watching the same movie with better special effects and trillion-dollar stakes. On November 21, 2024, Nvidia reported earnings. The stock jumped 16% in 2 days, adding $430 billion in market cap. That single move was larger than Pfizer's entire valuation. Think about the mechanics of what happened during those 2 days. Institutional ownership of Nvidia stands at 66% of all shares. The Vanguard Total Stock Market Index Fund holds $85 billion in Nvidia, representing 2.8% of the fund. BlackRock's iShares Core S&P 500 ETF holds $72 billion. AQR Capital's Momentum Funds have an 11% allocation to Nvidia alone. This isn't diversification. This is synchronized exposure operating at a scale that would have been unimaginable in previous cycles. When the stock rises, automatic buying from index funds amplifies the move through the delta hedging mechanism. I'll explain in a moment. When it falls, that same mechanism works in reverse with equal force. The concentration has been built into the plumbing of our financial system. August 5th, 2024, gave us a preview of what the unwind might look like. Markets called it AI Unwind Day. Nvidia fell 15% in a single session. Microsoft down 4.8%. AMD down 8.2%. Combined single-day wealth destruction reached $765 billion. What triggered it? The Bank of Japan raised interest rates from 0.1% to 0.25%, a tiny move in a faraway country. But it caused yen carry trades to unwind, revealing the hidden leverage. Underneath the AI rally, here's what that revealed about our current market structure. AI stocks weren't just being bought with American investment dollars. They were being bought with borrowed yen at near zero interest rates, just as 1920s stocks were bought with borrowed dollars. The leverage isn't visible on balance sheets. It's hidden in currency markets, options positions, and offshore vehicles. We only discover it exists when something breaks. Let me explain the options amplifier that's making this concentration even more dangerous. Daily call option volume on Nvidia averages 2.8 million contracts. Each contract represents 100 shares, meaning 280 million shares of daily leveraged exposure. When retail investors and hedge funds buy call options betting on Nvidia going higher, the market makers who sell those calls must buy Nvidia stock to hedge their risk. This is called delta hedging. It creates mechanical buying pressure that inflates the price independent of the company's actual fundamentals. In September 2025, according to CBOE data, Nvidia's options volume exceeded its actual daily stock trading volume on 12 separate days. Think about what that means. More synthetic leveraged exposure was being created through options than actual shares changing hands. This is the modern version of 1920s margin lending. It's hidden leverage that amplifies both the rise and the inevitable fall. On June 18, 2024, Nvidia became the world's most valuable company with a market cap of $3.34 trillion, surpassing Microsoft and Apple. The company was trading at 48 times revenue, not earnings, but revenue. For comparison, at the 2000 peak, Cisco traded at 35 times revenue and was considered absurdly expensive even by bubble standards. Nvidia's forward price-to-earnings ratio hit 52 times. The narrative driving these valuations was identical to every previous cycle. AI will change everything. The technology is revolutionary. This time is different. But here's what should concern us about the timing. The Federal Reserve held rates at 5.25 to 5.5% through 2024, a restrictive level designed to cool speculation. Yet AI stocks kept rising. Why? Because institutions were front-running the anticipated rate cuts. Same pattern as August 1929, when the Fed's sudden hawkishness after years of easy money caught concentrated portfolios completely off guard. By March 2024, the Federal Reserve had reduced its balance sheet from $8.9 trillion in April 2022 to $7.4 trillion by November 2025 through quantitative tightening. That's $1.5 trillion in liquidity removed from the system. Yet the concentrated AI stocks continued rising throughout this period. According to Federal Reserve flow of funds data, money was rotating internally from bonds and other stocks into the Magnificent Seven. This internal rotation created the illusion of strength, while concentrating systemic risk in a narrower and narrower group of stocks. When a negative catalyst appears, whether it's an earnings miss, regulatory action, or external credit event, there's no diversification left to cushion the fall. Just synchronized selling across institutions that all hold the same positions with the same leverage at the same time. So, who wins and who loses when this pattern completes its historical cycle? Let me show you exactly where the money flows during these unwinds. Tiger Global, Sequoia Capital, and SoftBank took partial profits in Nvidia during the first and second quarters of 2024, banking billions while maintaining positions. In 1929, Joseph Kennedy famously exited stocks in September and then profited by shorting the decline. The pattern shows that sophisticated capital senses extremes and reduces exposure, while retail investors and passive index funds continue buying automatically. Market makers and volatility traders profit enormously during these transitions. Citadel Securities and Virtu, financial make money from widening bid-ask spreads when volatility spikes. During the August 2024 unwind, Citadel earned an estimated $400 million in a single week from volatility trading, according to industry sources. They're positioned to profit regardless of direction because they're facilitating the panic rather than taking directional bets. Short sellers with proper timing also win, though the current setup makes this particularly interesting. Bill Ackman's Pershing Square purchased put options on Nvidia in October 2024, later disclosed in 13F filings. But here's the key data point. Short interest in Nvidia sits at only 1.2% of float as of November 2025. That's extremely low. In previous bubbles, high short interest cushion declines because shorts had to cover, creating buying pressure. This time, the decline won't be cushioned by short covering. It will be pure selling into a vacuum. Now, let's talk about who loses, because this is where it gets personal for most Americans. 165 million Americans have 401k accounts with 32% exposure to 7 stocks, whether they know it or not. The Vanguard Target Retirement 2045 Fund, designed for people planning to retire in 2045, has 12% of assets in just Nvidia, Microsoft, and Apple combined. During the 2000 to 2002 dot-com crash, the Vanguard 500 Index Fund fell 49%, specifically because of technology concentration. Pension funds with benchmark mandates are trapped by the same mechanism. CalPERS, the California Public Employees Retirement System, held $18.2 billion in the Magnificent Seven as of June 2025, according to their public disclosures. New York State Teachers Retirement held $14.7 billion. These institutions cannot deviate meaningfully from benchmarks without career risk, so they remain fully exposed even if individual managers see the danger. Late-stage retail investors consistently lose the most in these cycles. Robinhood data shows Nvidia is the #1 held stock among retail investors as of November 2025. Fidelity reports, Nvidia is the top holding in retail brokerage accounts across their platform. History provides a clear pattern here. Retail inflows peak at market tops. In January 2000, retail inflows to technology mutual funds hit $44 billion, a monthly record. That was the exact month before the market peaked. Let me bring this back to that September day in 1929 when 5 stocks dominated the market. Institutional investors believed they had identified permanent winners in permanent growth industries. Were they right about the industries? Absolutely. Radio, electricity, automobiles, and telecommunications did change the world exactly as predicted. Were they right about the stocks and the timing? Catastrophically wrong. The concentration itself created the fragility that guaranteed disaster. Today's AI revolution may prove as transformative as electricity. The technology might exceed even the most optimistic projections. But when 7 stocks hold 1/3 of our market's value, bought with hidden leverage, held by institutions that must match benchmarks regardless of valuation, and priced at multiples seen only at previous bubble peaks, the historical pattern suggests a violent divergence is coming between the revolution and the stock performance. The mechanism doesn't require fraud or conspiracy. It just requires human nature, cheap credit that's now being withdrawn, and career incentives that make herding rational until suddenly it isn't. According to the World Gold Council's analysis of historical market cycles, the pattern completes when concentration reaches 30 to 35% of market cap. Credit conditions shift and momentum reverses. We're at 32% concentration as of November 2025. The Federal Reserve has removed $1.5 trillion in liquidity. The only variable remaining is the timing of when momentum reverses. For those of us with retirement savings caught in this machine, the question isn't whether AI will transform our economy. The question is whether 7 stocks trading at historic valuation multiples can maintain 1/3 of our market's value, while the Federal Reserve removes liquidity, and eventually a catalyst emerges that breaks the synchronized buying. History suggests they cannot. The pattern suggests a 65 to 75% decline in the concentrated names would simply match what happened to RCA, to Cisco, to the Nifty 50, and to every other generation's permanent winners that proved temporary. This isn't about predicting the future with certainty. It's about recognizing that we've seen this movie before, and the ending doesn't change just because we're using better technology to film it. The mechanism remains the same. The concentration is undeniable. The leverage is hidden but present, and the historical precedent is unambiguous. Understanding this pattern doesn't tell us the exact day the reversal begins, but it tells us what we're watching for and why concentration at this level has never persisted through a credit tightening cycle. That knowledge, at minimum, helps us see our actual exposure rather than the diversification illusion our statements might show.